Thanks everyone for joining. I'm really happy to have you all here. And I think only 3 days ago I started sharing, and still all of you showed interest and also joined. So thanks again. Quick intro about our speaker, Neander Selvan. I know Selvan ji for last couple of years. And most of you also probably know from his very popular, thoughtful Facebook articles and uh, Indian expat group posts. So he has written a lot of articles on fire and helped lots and lots of people. So I'm very happy that he accepted when I asked him 2 months ago whether he can do a webinar for our community. And here we are. Floor is to you, G. Thank you.
Thank you, Karthik. Hello, everybody. Warm welcome to the meeting on fire. Thanks for Karthik for hosting the event. So I am sharing my screen. So let me just go to the slide. Okay, I think I have to.
Please mute yourself. G, how do you want to handle the questions? Do you want at the end or after each slide or each topic you covered? You want?
Yeah, actually, people can post the questions in chat, and I
Okay.
can
I
see
can.
and I can reply. I have some questions already, so I have added some questions which people sent in the thing. So in
Sure.
between, you can post questions in the chat, or you can raise your hand, and then I can.
Yeah, I can ask. I can
Yeah,
basically ask the question whoever posting in the chat. Yeah.
sure. Thanks.
Thank you.
So I'm just trying to find the PowerPoint.
Oh, the presentation mode
Yeah,
should be top right or
let
in
me.
view, in the menu view
Yeah,
probably.
I actually like I'm just try to. I think I have to restart it. Okay, let me restart the. Okay, so I hope you all can see the PowerPoint.
Yes,
Okay,
but
thanks.
it's not in the presentation mode.
Yeah, I'm just going there and changing that.
Okay, perfect.
Okay, so the FIRE, financial independence, is the acronym for financial independence and retire early. So most of you would have been familiar with the idea, retiring early and the FIRE movement. So fire movement begins with there are some one core rule of the fire movement is the 4% rule. So the 4% rule says that you need a portfolio that can whose with 4% can support your annual expenses. So to give an example, so let us say your annual expenses is $20,000. So 4% of 25, if you multiply it by 25, it is 500K. So the 4% rule says that if you want to spend $20,000 in retirement annually, you need a $500,000 portfolio. If you want to spend $40,000 annually, you need $1 million portfolio because 4% of $1 million is 40,000. And if you want higher amounts, 58,000, 1.46, you want to spend 80,000, 2 million. So, like when people see the numbers 1.4 million and 2 million, first thing is a lot of people say, okay, let me stop here. I cannot get $2 million portfolio in my lifetime. So don't worry because this is just a rule. There are a lot of revisions and there are a lot of modifications to this number. So we'll go through all that. But this is the starting point. So if somebody wants to plan early retirement, you have a goal. Like people need a goal, right? So this goal, like maybe you can start with 1 million. Don't worry how much you have, how many years you have, and you might think 1 million today is not going to be 1 million in 10 years. But again, start with $1 million. I mean, if you have 100,000, 200,000, whatever current 401k value you have, Start with the goal of $1 million and see where it takes you. And this is just the portfolio value for retirement. Don't confuse this with your net worth, because a lot of people have a house and they might have assets in India, they might have jewels, they might have gold, and they might have 529 accounts for their children's college accounts. So don't include all that into this calculation. If you want money for your kids' education, you want money for paying off your car, so those things are completely separate. This is just your retirement portfolio. And you can tell you in the beginning that the average American is nowhere close to any of these numbers, not even the 500K number. The average American is retiring somewhere with median household savings of $100,000 to $200,000. So how is that possible? Because the median or the average American is retiring late at 65, 67. And when the median average American retires at 65 and 67, they get Medicare and they get true social security checks. Husband gets a social security, wife gets a social security check. With a paid off house, you get $3,000 each. That means $6,000 per month, $72,000 per year. With a paid off house, that is more than enough for the Americans to retire. But the math changes. If you want to retire at 55, you want to retire at 50, and there are people who push it even earlier. So that's when all this early retirement math comes into equation. So one audience question was asked. So this 4% study was done by Bill Bengen. So Bill Bengen study focuses on a typical retirement like 65 with Medicare, and 4% makes sense. But is it still valid for someone who wants to retire in 50 or 55? So the person wants to know whether any study that suggests a percentage withdrawal that is time tested for 50 years. So 50 years, no, because Bill Bengen study only covered a 30-year time period. So Bill Bengen study, the study covered a time period from 1926 to 1994, so which is nearly 70 years. So he only did it for 30 years. So he said that if you're only withdrawing 4% of your portfolio, and the portfolio he mentioned was 70% stocks and 30% bonds, not 100% equity. So if you have a portfolio of 70% stocks and 30% bonds, then you can retire at any time between 1926 and 1994, and your portfolio would have comfortably lasted for 30 years. So that was the conclusion from his study. So 30 years is quite good, because you retire at 50, 30 years takes you to 80. And when you are 80, like you already would have got your Medicare, you'd have your social security. So 30 years is quite enough. Like unless we are talking about retiring at 25 or 30, like even if you retire at 30, a 30-year time period will take you to 60, right? So, if a portfolio lasts till 30, he never said the portfolio is finished completely at 30. No, he only said that it will last 30 years. So beyond that, if you are calculating for 50 years, that's nobody's hand. Nobody knows those calculations and the math. So 30 is quite good.
One more question, G, from the
Yeah.
audience. Why 4%? Is it because of the dividend payout from SEHT?
No. The 4% was the maximum number which Bill Bengen could come off. So he tried different numbers, 5%, 6%, 3%. So the 4% was the maximum possible withdrawal that can help your portfolio last for 30 years, from a period of 1926 to 1994. Remember, this period had like Great Depression, 1929 to 1940. 10 year we had a Great Depression. So he said like this 4% rule would even save you during the Great Depression. If you retire in the peak of the Great Depression with your entire portfolio tanking, still the 70:30 portfolio will save you for the next 30 years. So that's why he came up with the 4% number. But again, this 4% number has been revised by Bill Bengen recently. So again, the study was done in 1994. So he revised the study in 2005. He wrote a book, and then he said that I included the period from 1994 to 2025, and I included only stocks and bonds in my earlier research. But now I'm including other assets, like I'm including small cap stocks. So I'm including Nasdaq. So if I include all this, I find that from any period from 1926 to 2025, you can withdraw safely up to 4.79%, or like even 5% withdrawal is possible. So which basically means that your portfolio number drops significantly. So like if you look at this 25, by using the 4.79%, you need to multiply it by 21. So which means that if you want $40,000, you'd only need an $800,000 portfolio, which actually is very, very good news for us. So remember, the 4% rule is commonly cited. You go to a financial advisor, the advisor will tell you 4%, but again, the advisor may not know. Again, he or she might know. But please note that the 4% rule has changed now to 4.79%, even though nobody is calling it the 4.79% rule. Still, as a rule of thumb, like 1994 to 2025, nearly 3 decades, people have been using the 4% rule religiously. So, but again, the number has changed now. So, one question, this was another audience question. How does someone calculate their fire number? What are all the factors to be considered? So I came up with a scenario for this. All the numbers math was done with the aid of ChatGPT. So like I assumed a husband and wife. The husband's age is 55, wife is 50. Their annual expenses is $60,000 and the inflation is 3%. So this is somewhat reasonable numbers because the $60,000 number, it comes from our Fire WhatsApp group. I asked people how much is your monthly spending, and don't include your house EMI or car EMI or any expense for your children's college or anything, just for two people, like running expenses, electricity, utility, food, groceries, real estate taxes. So including all this, how much do you spend? So the numbers came from $4,000 per month to $5,000 per month. So I took the maximum amount, $5,000, which is $60,000, which sounds reasonable for two people. So if a husband is 55, wife is 50, assume both have worked at least 10 years each, so that they both are eligible for Social Security, and their annual expense is $60,000. The inflation is 3%. So remember, the Medicare starts only at 65. So which means that the husband would need Medicare for 10 years. Husband will need health care for 10 years until his Medicare kicks in. The wife will need health care for 15 years, from 50 to 65. So they need at least health care coverage for 15 years. So one option to cover healthcare, healthcare will be your primary expense. So like you go to Obamacare or the Affordable Care at ACA Marketplace. So at least in Wisconsin, the lowest health insurance policy you can get is high deductible healthcare plan. The premium comes somewhere around $13,000 per year for a couple, with a deductible of around $7,000 to $6,000. So I calculated you need $20,000 per year if you include deductible plus premium. So I just multiplied 20,000 by 10, husband's age, right? So 10 years, so which means $200,000. And like, you invest $200,000, it grows at 5%, 6%, 8% in the index funds. So like $200,000 could easily cover healthcare of the wife also up to 65. So I would like, if anybody is retiring early, I would request them to multiply the number of years the youngest spouse has until she turns 65, so that like for each year multiplied by 20,000. So that would be enough for the healthcare. So, or you can have a round number, 200,000 to $250,000. You can specifically allot only for healthcare. And you can include the HSA, like a lot of people have HSA. So HSA is a very, very great option because HSA is triple tax protected. Like when you take money from HSA to invest in HSA, a lot of companies do employer matching. And like even your social security, Medicare taxes are not taken away from the money you set aside for HSA. And the HSA money is also tax deductible, both when you invest and also when you take it out. So the HSA would be a very, very great tool to have in your early retirement.
I think you quickly touched upon the invest part. Can you elaborate on how do you use HSA for investment? A lot of people don't know about this part.
Yes. So your HSA provider, again, each one of us will have a different HSA provider. And again, our employer chooses the HSA provider for us. So we don't choose the HSA provider, at least for many companies. I mean, there are companies which might allow people to choose their own HSA. But no matter like where you work, which HSA provider you have, they have investment options. And I would assume that a vast majority of HSA plans will have an S&P 500 investment option. So you can invest your money in HSA. At least I'm telling what I'm doing. So I'm using an HSA. I'm like they permit up to $8,500, and there is also employer matching for that. So I
So,
invest the entire $8,500 each year into HSA, and it is being invested in an S&P 500 fund, and I'm not taking money for the deductible. So I'm just paying it from out of pocket, like I'm paying
okay,
it with my credit card.
let's see. That's a good
So
point. So, even though you have HSA, you are not using for any medical expenses. You are
no,
purely using it for investment purposes.
yes, I'm purely using it for investment purpose. Only the reason is when you are working, your income is high. So you can I mean it depends upon person to person, but at least I find that because my our healthcare bill is not high, like we are all perfectly healthy, and we don't have many major illnesses or problems except fever, some like a flu vaccine. Other than that, we don't have many issues. And annual checkup, when we go to India, we get our annual checkups there. So like our dental, we have separate coverage for dental, so we don't need to like take money from HSA. So that's why we have a high deductible healthcare plan. And every year the amount is also like the copay and everything, it's very, very less because we don't generally use it. So we don't take money out of our HSA, and we pay it out of our credit card, and then we pay it back. So, and when you're doing it, please save all the bills, because this is very important. When you're paying your HSA, save the doctor bill, save the bill from the credit card company showing that you made the payment, and you can digitally save it anywhere. You can email it yourself, you can save it in Dropbox, wherever you need, and you can withdraw that money anytime tax free. So let us say you are spending $10,000. I'm just saying you are spending $10,000 in 2026. In 2036, you can use the bill. After you retire, you can take $10,000 out of your HSA. It's completely tax free. You can use this bill like there's no limit. You can take money you spent 30 years ago. Again, it's not going to be taxed in any way. So I'm just having it as a backup. But the main reason I'm having a HSA is that I expect once I retire, and then that is when I'll use my HSA funds. So then the deductibles and everything will become more. So then I will use my HSA funds after retirement. So that's the purpose of doing that.
Great point. Thanks, G.
So, so according to this math, like you have a healthcare bucket of $200,000, and you need a bridge portfolio needed to take the husband from 55 to 62. Why 62? Because the husband plans to take Social Security $2,500 per month when he turns 62. So the husband's income will increase by $2,500 when he becomes 62.5. And when the wife becomes 62.5, she can also take her Social Security check. So they will get their income will increase by another $2,500. I'm just using a round number, 2,500. It could be like anywhere depending upon your income, depending upon how much taxes you paid. And like if you take Social Security at 70, like again, that would be a very, very great option, taking it at 70 for the highest earner in the household, because I'll talk about that later. But assuming in this case, assuming both take it at 62, which means that once both of them are taking their Social Security, 2,500 per month for one person would means $5,000 for the family, and they'll be getting $60,000 when the wife becomes 62.5. See, they only need a portfolio that can take them from the husband's age from 55 to 62 and wife from 50 to 62. So doing all the math, ChatGPT says that you would need a $547,000 portfolio to take you from 55 to 62. And after the husband becomes 62, your portfolio size would need to be $600,000. I used a 5% withdrawal rate using the Bill Bengen's latest number. So if you are 50, if the husband is, so in this case, the husband is 55, wife is 50, annual expenses is 60,000, inflation is 3%. The total portfolio needed currently is 1.1 million $47,000. So that is a number. So anyone can do a similar math in ChatGPT, in Gemini. You just have to include all the factors. This is my age. This is my wife's age. You can actually go to Social Security, ssa.gov. You can create I hope most of you have an account in ssa.gov. It is free. It will tell you how much Social Security payments you would expect to get if you retire at this age. So, or you can even ask ChatGPT and Gemini to calculate that for you. So you can easily run this prompt in ChatGPT or Gemini, and then it can give you your portfolio number. So again, this is just an example. How do you calculate your fire number? You include all these variables. Some variables would be unique to you. Like for example, there might be a single earner household, or there might be a household where only a single person is there. So again, those things are completely different, unique to each person's situation. So again, it's very easy to calculate the fire number with AI in this method. So how much money do I need to retire? So if you need a ballpark number, using the 4% rule, it depends upon what kind of retirement and what kind of lifestyle do you want, right? Again, the number 1 million might sound very, very intimidating. But again, you don't need 1 million. There are many websites, the YouTube channels called Retire with 500K. There are many people who have successfully retired with 500K, but they are all singles. At least none of them are a couple. And there is a channel called Happy on Mondays. So she retired with 500K, but she is a single, and she is 60, and she plans to take her Social Security at 62. So again, I'm just giving an example. Or there are different other options. If you have $300,000. Indian retirement is easily possible. You have, let us say, you have a house in India, a $300,000 portfolio, invest in S&P 500, you move to India, and then you withdraw the money every month in INR. It can easily give you a income of 100,000 rupees per month, which should be very, very good amount. If we are talking about only two people, husband, wife, a fully paid off house in India, no college expenses. $100,000 is more than enough. You can easily even do 1 or 2 foreign trips a year. Foreign trips means like Sri Lanka, Thailand. I mean, you can buy tickets when the tickets, flight tickets when the tickets are cheap. I mean, there are very cheap Airbnbs. I've been to places like Bali, only $40-50 per night. So it's very easily possible. You can live a very, very good life in India with $300,000 to $500,000. And a lot of people would have that money if you include home equity, money in 401k, or brokerage accounts, or IRA. I mean, it's not difficult to retire in India with this amount of money.
Question G. What would
Yeah.
be a sustainable withdrawal strategy for my portfolio after I turn 65?
Yeah, any sustainable portfolio, 4% is the sustainable number, because Bill Bengen calculated the number based upon Great Depression. So a 4% withdrawal rate would sustain you even during the Great Depression. It would sustain you even during the 2000 internet meltdown. It would sustain you even during the 2008 real estate collapse. So it would sustain you any time from 1926 to 2025, even during COVID. But again, remember, past is past. God knows, the AI bubble, people are saying AI is a bubble, and if there is something that happens 10 years slump and all, that's completely different. That's in nobody's hands. But according to what we know, 4% up to 4.79% is a highly sustainable withdrawal rate. And remember, like once Social Security, Medicare kicks in, like the 4% itself is too much. Like let us say a family gets, let us say take the bare minimum, $2,000 each. $2,000 each means you get $48,000, right? And when you have a paid off house, you have $48,000. Yeah, I mean, how much more money do you need? Like, I mean, it's just two people. We are not talking about other expenses. I mean, if you talk about old age care, that is different. Like, if you get admitted in a nursing home, like it can cost anywhere between $100,000 a year, but nobody gets admitted into a nursing home, even in America. It's very, very tough. Like what happens is their children take care of them, and the children would get money from the parents. The parents will give the children the social security checks, the inheritance, and in many states, the Medicare and Medicaid are paying adult children to take care of parents. So there are so many other options for old age care. And in worst case situations, like we can always go back to India, find a nursing home, even appoint a nurse. Our children can pay for that through our social security check manager. So there are multiple different options. But if you want a number, 4 to 4.5% is a highly sustainable number, withdrawal number. So how does the 4% withdrawal strategy work in a $1 million portfolio? So again, I used I showed I made the numbers from ChatGPT. So let us say somebody retires in 2027 with a beginning balance of $100,000, and the market grows at 8%. Like the S&P 500 for the last 120 years has grown at a cumulative compounded rate of 10%. But again, this 10% is across the entire 120-year history. But if you take individual years, like the year 2000, we had nearly a 20% collapse. In the year 2008, we had a 40% collapse. So like individual years can vary, but again, on average, S&P 500 has given nearly 10% cumulative returns. So I took a very safe 8%, a very, very conservative 8% return number. So your portfolio begins at $100,000, you withdraw $40,000, the ending balance is $1,036,800. So you can see the next year we assume a 3% inflation. So you spend $40,000 this year. Next year you spend $41,200. In 2029 you spend $42,436. So you find that your portfolio value only keeps on increasing year after year. So this can continue for 30 years, 40 years, or 50 years, as long as these assumptions are true, unless we know something terribly happened to the American economy or the S&P 500, which I don't think is possible. But again, nobody knows the future. But again, I would say that United States economy, like Warren Buffett said it very beautifully with a quote: "Don't bet against America. You always bet for America."
Yeah.
So anybody who bets on the American economy performing well will be handsomely rewarded, according to Warren Buffett.
Yeah.
So when you bet on the S&P 500, you are betting upon the top 500 companies in America at any given year. So these companies can change year by year. Like Nvidia is the number one. Like previously it was Apple, before that it was Microsoft, before that it was General Motors. So the companies might change, but the top 500 companies in America, they will be a very significant indicator of the state of the American economy. So that's how the 4% annual withdrawal method works year after year.
Can we say like this? If we, let's say S&P 500 is not doing well as we thought, then we have much more bigger issues than worrying about
Yes.
the portfolio.
Yes, that's a very, very important point. Yes. So if the S&P 500 doesn't do well, so like S&P 500 companies' revenue, they equal the GDP of the United States of America's GDP. So if S&P 500 fails, it means the entire United States economy has failed. And as you rightly mentioned, it means we have bigger issues to worry about. So better we pack up and move to India or something else. So but again, don't worry, that never happens. I mean, we can sit and worry about so many things that happen, right? Oh, what happens if the earth falls down? Like, what happens if there is the earthquake, right? I mean, we can worry about so many things, but again, don't worry, because, like,
It's still better. We have so much time to worry than still working and, worry.
yes, yes. So this again, the 4% rule, S&P 500, they cover the last 120 years history. So think about what has happened in the last 120 years. We had two world wars. We had a Cold War. We had a Korean War. We had two Gulf Wars. Now we have the third Gulf War. We had COVID. We had the mortgage meltdown. We have the internet bubble or the Y2K bubble, whatever you call it, in the year 2000. And we are now in the AA bubble. So it has seen everything. Like God knows what will happen in the future. So don't worry. You'll do fine. So there is another strategy called the guardrails withdrawal strategy. So it lets you withdraw up to 6% in a year. So which means that you have $1 million portfolio, you can withdraw $60,000. So like you might be surprised. Oh, $60,000 looks great. But is it sustainable? Yes. Because as you can see, like S&P 500 gives you 8% per, like we assume an 8% growth per year. So if the stock market grows at 8%, why not withdraw at 6%? There is no reason why you should only withdraw 4%. So like if you look at the last 6 years, I mean, don't even look at the last 6 years. You go back to 2009, that's when the real estate bubble ended. So after 2009, we had only like 3 negative years. So I think 2017 was one negative year, 2022 was one negative year, and in between there was 2013 or 2014, and like the 2022 we had 20% fall. In 2016 we had around 8 to 10% fall, and 2014 we had a small minus 5%. So all other years the stock market growth has been in double digits, 10%, 12%, 15%. So which means that if you retired in 2009 with $1 million portfolio, you'd be sitting now with a $4 million portfolio if you use a 15% compounded growth rate. I mean, the stock market has been amazing for the last 17, 18 years. We don't know whether it is going to continue in the future. But again, if the stock market goes up 8%, 10%, 20% in a year, why are you still withdrawing only 4%? So like, let us say you retire in 2026. In 2027, the market goes up by $200,000, right? And 20%, which is you get $200,000. So why are you only spending $40,000? I mean, take 6%, which means that you can easily take out $60,000 and you can spend it. The rest of the money you can reinvest in the portfolio, and then it can keep growing. So by using the guardrails withdrawal strategy, this strategy says that you can withdraw 6% after a positive market year. You can withdraw 3% after a negative market year, and withdrawals are taken at the beginning of each year. So all of these strategies, the guardrails withdrawal strategy, this is time tested. This is again tested back in portfolio for so many years. So there are some drawbacks in this method because, like, for example, I use the actual numbers from the years 2020 to 2025. So if you use the guardrails withdrawal strategy, you can see that in 2020, instead of 4%, you can withdraw 60,000. And in 2021, 64. In 2022, you can withdraw 73,000. But in 2023, you can only withdraw $28,000 because the year 2022 was a negative year. But again, the next year it goes up to $66,000. So one option which you can do to smooth this out, like again, when you in the years in which you have spent 73, 64, coming down to 28, it will feel very, very bad. So don't worry about that. We have another strategy to help us, and that is called the bucket strategy. So the bucket strategy says that, like again, we use the example of 20%. So you retire in 2026, you get 20% return, $200,000. So what you do is you spend $60,000 and then you take the extra 140,000 and then you put it in a CD. You can put it in a CD, you can put it in government bonds, you can put it in money market accounts. Currently, they are giving you anywhere from 3% to 4%. So imagine, in the first year, you get $60,000 to spend. You have extra $140,000. You invest them in CDs. You have next 2 years expenses taken care of. So if you did this in the year 2020 when we had that's my Siri. Okay. So if you use that logic, you can withdraw the 15%, you can withdraw the excess amount, put this in a CD, put this in a bond, and then you can use that money to smooth out the difference in the year 2023. So that is the bucket method. So the bucket method says that in the first 1 to 3 years of your retirement, don't depend upon the mercy of the stock market. So you have $1 million portfolio, like you are planning to spend 3 years, $40,000 each. Invest $120,000 in CDs, bonds, and everything. And if the stock market is good, great. You don't touch that. You take the money from the stock market and spend it. If there is a stock market collapse, if the stock market falls 20% in the year in which you retire, don't touch your stock market portfolio, but take the money from the CDs and spend for up to 1 to 3 years. So if you have cash with you as CDs or bonds that can help you last the first 3 years, then definitely the fourth, fifth, and sixth years you don't need to worry, because there has never been any time period apart from the Great Depression. Only during the Great Depression we had continuous 3 negative years, and after that we never have had any 3 negative years, and the portfolio would recover. So you need to split your portfolio into CDs, in bonds for up to 3 years. For up to 3 to 5 years, ETFs, mutual funds, insurance, and up to 10 plus years investments can be in long term bonds and annuities.
A couple of questions, G.
Yes.
Are we talking about SCHG or SCHD or SP 500 WU in terms of portfolio?
Yeah, only S&P 500, which is VOO.
Okay. Second question is, how do we balance the portfolio between these three, SCHG, SCHD, WU?
Okay. That's a very interesting question, because SCHD, like currently it is giving you 3.27% yield, which is equal to the money market account, or which is equal to the high yield savings account offered by many banks. And if you're really like, I personally have invested instead of having money in bonds, I have put money in SCHD. So that is my replacement. But again, I did that only because I invested in SCHD when the yield was very, very high. Like in 2022, 2023, SCHD was giving nearly like a 3.5 to 3.75% yield. And I also got some other dividend stocks at the time. I mean, I made that mistake. I invested in some individual stocks like Bank of America, which the stock price was very, very less at the time, the $30. Currently, at the time, it was giving a dividend yield of 3.1%, and dividend yield only goes up by 7% every year. So that was an amazing buy at the time. After that, I realized I didn't lose money on that, but again, I realized it's not a good idea to buy individual stocks, only buy ETFs. So I stopped buying individual stocks after that, but still I did not sell them, because if I sell them, I will incur significant capital gains taxes, and they are good stocks. Bank of America, I bought it only because it was a Warren Buffett stock. Warren Buffett has invested heavily into it. So again, at the time my thought was different, but now I only do ETF investing. So like again, if you are considering investment in SCHD, I would encourage you to buy SCHD like 3 to 4 years before retirement. Because in the long run, the longer time you have for retirement, say you have 10 years, 15 years, please invest everything in VOO. Or you can do SCHG. SCHG is a concentrated form of investment. The only difference between SCHG and SCHG and VOO is that SCHG invests in the top 100 stocks. VOO invests in the top 500 stocks. So which would mean that if the market growth is very high, like look at the last 5 years, SCHG has outpaced VOO, because the market was very, very high. The Magnificent Seven, only 7 stocks managed to pull out from the 500 stocks, and the 7 stock lifted the entire US economy. Right now, like the Mag 7, people called them by different names. Fang, Mang, they called it by the different names. So SCHE benefited heavily by being in the top 100, invested in the top 100 stocks rather than the top 500 stocks. But again, the reverse is also true. If the AI bubble becomes worst, then the top 100 stocks will fall heavily than the top 500 stocks. So that is the balance. I would say like there can be a good balance between SCHG, SCHD, and VOO. A lion's share of your portfolio should always be in VOO. Like, for example, my 401k doesn't have any SCHG because 401k plans are very, very limited. So 100% of my 401k, my wife's 401k, everything goes to VOO only. I mean, not just VOO, but the 401k S&P 500 plan offered by our 401k provider. They give different names for that, different ticker symbols, but they are all S&P 500 with very, very low fees than VOO. So go ahead, go ahead.
Yeah, I think it's just a yeah. So
Okay, I can continue. Okay.
yeah, next
So
one.
yeah, so 401k mostly invest only in S&P 500, and you have excess money, like for example IRA. You can invest in SCHG, and when you retire, you can convert a portion of your IRA or a portion of your 401k into either into SCHD, or you can convert that into bonds or CDs.
Yeah, two more questions, related questions. Are
Yes.
tax on withdrawal being calculated in all these scenarios? Is there, can you also talk about the numbers after tax?
Yes. So that's a very, very interesting question because in retirement, our income would be very, very less. Like, for example, let us say you are a couple, married filing jointly. The first $32,500 of your income will not be taxed at the federal level. So if you retire and you withdraw like $40,000, like we are only talking about numbers like 40,000 and 60,000, right? So if you have a traditional 401k, you withdraw $32,500, it is not taxed. And if you withdraw the rest of the amount, like $40,000 minus $30,000 equal to $8,500. So on the $8,500, you will pay a 10% tax because the tax rate is 10%. So which would mean that your taxes will be only $850. So that is not much. In retirement, your taxes will not be much. And if you keep your income below $55,000 in retirement, which is very much possible, you can, if you keep your income below $55,000, you qualify for Affordable Care Act subsidies, and your health care will also, health care bill, you don't need $20,000. Like your premium will be like very, very less, maybe like $300-400 per month. So yes, there will be taxes, but again, there are many different ways in which you can approach the taxes. One is Roth IRA. If you put money in Roth IRA, the withdrawals are all completely tax free, so you won't pay any taxes. Other option is SCHD. So again, remember we talked about SCHD, and remember I have invested in SCHD and I have invested in Bank of America. As I said earlier, they all give dividends. Dividends when are not taxable. I mean, yes, they are taxable, but in retirement you get a very good advantage if you invested money in dividend stocks. That is, until if you are married filing jointly, if your income is below $94,500 in a year. So in retirement, I don't think anyone plans to get more than $94,500 per year. So let us say you are taking $50,000 from your 401k. That means the for $50,000 you're taking out from a traditional 401k, 32,500 is tax exempt, and the rest $18,000 has a 10% tax. You pay $1,800 tax, and let us say you are getting $40,000 in dividend. So which would mean that your income will be $90,000, $50,000 withdrawal and $40,000 as dividend. I mean, nobody's going to get $40,000 as dividend, but I'm just using a very wild example to highlight the point. So in the 94,000, if since your income is less than $94,500, the $40,000 in dividend is entirely tax free, 0% tax. So you don't pay any tax on that. So the same rule applies if you sell stocks, like you sell SCHG and you get a long-term capital gain. So which means that you must have held the stock for more than a year. Even that long-term capital gain is tax exempt. So you don't pay any taxes in retirement. You pay very, very less. Plan to pay very, very less in taxes in retirement.
Okay. Next question. So we have to withdraw $40,000 per year one time or 3,330 per month. How does that work?
Yeah, there are many different answers to that question. So one question is like one option is like um, by the end of the previous year. So let us say that like for example in the year 2025 we had a 20% market rise, right? So we had a 20% market increase. So by December 31, like just take out the entire 4% for the next year. So which means that you sell stocks before December 31 and have the next year's gains locked in. So next year, like even January, February, we had a market collapse. We had the Iran war. The market fell and it also went up. But again, you don't need to worry anything because in 2025 you have cash debt. You have the $40,000 locked in CDs. So from the CDs or from the money market account, you can easily take out 3% every month. And again, like, but yeah, that's the best method because don't depend upon the mercy of the market each month. So simply withdraw the money and put that in CDs or put that in money market account, put that in bonds, so that for the entire year, every month you can get paychecks reliably.
Okay, yeah, we can move on to next.
Thank you. So as I mentioned, in the last 120 years, the US stock market index returns for this number is from Google. So over the last 120 years, the US stock market has delivered a highly robust long-term performance, compounding at an average nominal annual return of roughly 10% to 12%. So really 10% to 12%. So if you adjust to inflation, so inflation is around 3 to 4% every year. So we use a 3% number. So you adjust it for inflation, it gives you nearly 6 to 7% every year. And the S&P 500 doubles in value approximately every 10 years. So which means that if you retire with $1 million portfolio in at age 55, at age 65, you will have $2 million portfolio with you. So that's an amazing number. And the US stock market is a very, 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 very important tool for us. So again, the average numbers only tell us a certain thing, but you look at the individual years. So you can see that the years in red are all negative years. The years in blue are all positive years. So you zoom in. So you zoom in, you can see returns like 9% return, 17% return, 26% return, 29% return. And if you look at the negative years, you can see numbers like 0.5%, 0.1%, 0.36%. So like there are some huge years, like you can see like there is a 43% collapse, 34% collapse, but those are all like you can look at the last 1926 to 2022, you can only see like double digit losses 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 15 years, only 15 double digit losses. And you can see how many double digit gains we have, right? Single digit, double digit. So S&P 500 really like you can trust it. You can trust it. You have nearly 74% positive years, 26% negative years, and the double negative years would hardly be like 8 to 10%. So that gives us an idea of what we can expect in retirement. 75, you have a 75% chance of having a very positive year each year. So rules for FIRE. So again, when we talk about portfolio value and all, don't make the mistakes of buying individual stocks like SpaceX. Lot of people invested in SpaceX IPO. Again, I'm not targeting SpaceX. I'm just giving an example. I also told my example. I got Bank of America stock and like a couple other individual stocks. That was the time when I was not very clear on my investment policies. But after that, I stopped investing in individual stocks. Please do not buy individual stocks because nobody knows the future of any company like SpaceX, Tesla, Nvidia, Microsoft. Nobody can say with certainty what the future of the company is going to be. Like look at the SpaceX IPO. Like it came out with a lot of fanfare. Like right now, I think it is below the IPO price. So only do index fund investing. I would advise everybody to stick to index fund investing when it comes to stocks. When it comes to bonds, we have good options. We have BND, the bond index fund. You can invest in CDs. You can invest in JAAA, which is again a AAA rated index fund. So only do index fund investing. Don't buy individual stocks. You can buy dividend ETFs like SCHD, but again, remember SCHD might not give you the total return which VOO or SCHG may give. But again, it gives you a reliable 3.27% yield currently. And SCHD has historically increased its dividends by 5 to 7% in the last 15 years. Again, nobody can predict that's going to happen, continue in the future. But right now, like if you have only 5 years to retire, a portion of your money can be in SCHD, or you can do it in the year in which you retire, like so that you know for confirm. Okay, like for example, if you retire today, you have $1 million in your portfolio, you invest $1 million in SCHD, it would give you $32,500 dividends per year, which is not the 4%, but the dividend will increase 5% to 6% every year, so which would mean that you are definitely beating inflation. So a portion of your money can be in dividend stocks, but don't put everything in. Like there are people who do that. There are people who entirely retire with dividend stocks, but they bought those stocks when the yield was 5%, 6%. Like there are stocks that currently give you 8% dividend return, 6%, 8%. Like Enbridge, for example, a Canadian utility provider. But again, those are all like, I would say they are risky stocks. I would not say they are going to fail or anything,
Sorry
but
to
don't do individual
Sorry to
stocks.
interject, G.
Yeah.
In my screen, it says 45 seconds left. I don't know what it means. In case it ends, please join this new meeting number. I shared it in the chat link. Also, Neander G also shared his WhatsApp channel for Fire in the top. Please take that also. In case it ends, I'm not sure why it is showing because I put it for 3 hours. We are only 2 hours away, but I don't know why it is showing the uh, uh, time has only 15 seconds left.
Okay. Thank you. Thank you.
Yeah,
So,
yeah. Let's wait for 10 seconds and see what happens. If it ends, then we can rejoin with the new link I just shared.
sure, sure.
Okay, it's the timer. Yeah, the
We
countdown is
can
over.
continue.
Yeah, looks like,
Okay. Thank you.
yeah.
So do only passive investing. So passive investing means invest a certain amount every
ஷூ
year
கார்ல
using.
நினைக்கிறேன் ஷூ போடுமா
Sorry, can you
ஷூ
please
போட்டுக்கோ
mute yourself?
நான் ஷூ போட்டுக்கிட்டா
Whoever is talking, can you please mute yourself? I'm not able to mute you. Okay, thanks.
Thank you. So do only. So these are the rules. Index fund investing only. And again, these rules are not from me. These are like people from like Warren Buffett, John Bogle. Like even though Warren Buffett has a very successful investment philosophy, he says that only do index fund investing. He says if I die today, I would advise my wife to put the money only in index funds. So like index fund investing was is suggested by like people like John Bogle. He was the founder of the index funds. So like they are very safe. So please only do index fund investing. Don't buy individual stocks. You can buy dividend index fund, which is also index fund. Bond CDs, use IRAs, 401k, HSA to save taxes, and only do passive investing. Don't do trading. Don't do like options. Don't do things like momentum stocks. So please don't do any such activities. Even though however attractive you will see that, just be patient. As Warren Buffett said, stock market is the tool to transfer money from the impatient to the patient.
Yeah, a few more questions.
Yes.
List out few index funds.
Yeah. So the topmost index fund is VOO because it only has a 0.02% uh, management fee. And we have SPY, which is the oldest index fund. And we have SPYM, which is the same version of SPY. But this is also S&P 500. SPYM has even lower like it was launched to compete with VOO. So SPYM, I think, also charges 0.02%. So which means that you invest $10,000, they'll only take $20 as fee every year. So which is nothing.
Right.
So SPYM is a good index fund. VOO is an index fund. Your 401k provider, like if it is Fidelity, I think their index fund is FXAAX, which is mutual fund. I think FXAAX is a mutual fund. I might be wrong. And there are other funds like these are all based upon VIIX. Again, that's an S&P 500 fund. So again, these are all available in your 401k provider, but VOO is available everywhere. VOO, SPYM, and are available everywhere. Like you can buy it in any brokerage like Robinhood, Schwab, Fidelity, Vanguard. You can buy it everywhere. Only problem is minimum investment amount is $500, and like some like Robinhood permit you to buy anything partial stocks also. But if you only are doing like $100 per month, $200 per month, you can do a S&P 500 mutual fund like SWPPX, FXAAX. They all let you invest minimum up to $1 per month. I mean $1 at a time. So you can invest. You can start your investment with just $1 today. And there are other funds like Nasdaq is another popular index. And again, Nasdaq is the top highest flying stocks in the market that are not bank stocks. So bank stocks are not part of Nasdaq, but other than that, I think the top 100 stocks in US are part of Nasdaq. It has a higher volatility than S&P 500 because it is the 100 stocks. So QQQ is the most popular index fund for Nasdaq. So if you're investing in QQQ, like your gains can be very, very high and the falls can also be very, very bad. So please remember that. And again, a portion like 10 to 20%. Like if you have a larger time period, like let us say your son or daughter who is 25, you can advise them to put their money 100% in QQQ because they have at least another 20 years to retirement. So in 20 years time period, it will certainly give a very good return. But if they like, again, if it is generally, it is suggested to have a line share of your investment in VOO or S&P 500 and a portion of that in Nasdaq based stocks like QQQ. And there is QQQM, which again is the same from the same index fund. So QQQM has a lower fees than QQQ and it tracks the same index. So, and apart from that, you have SCHD, which is the dividend 100 index.
Another two more questions, G. Is it good time to buy VOO now or wait for market correction?
I mean, how do you know the market is good? So that is again another interesting Warren. There's a Warren Buffett quote for everything. So can anybody name the quote for this?
No.
Okay. So Warren Buffett said,
buy when there is blood in the market or something like that.
yeah, that's different. But
Don't time the market.
yeah, exactly. Yes. So Warren Buffett said, time in the market is more important than timing the market.
As
Right.
for
So what he said is, don't never ever try to time the market. Nobody knows, right? I mean, you think the market will correct. What is the guarantee that the market will correct? US stock market has always been, the PE ratio has always been high for the last 15 years. So if you waited in 2010 thinking that, okay, I'll wait for the market correction till 2025, you'll be like sitting with the money in your hand. There's no way for you to invest money. So don't think like that.
so much inflation.
Every month, please invest a portion of your paycheck in your 401k, no matter what happens to the market. The market rises, great, buy. The market falls, great, buy. So think like this. Go back to 2016 when people were saying, oh, market valuations are high, stock market is high. In 2016, if you had bought stocks at any price, highest price, it would be a bargain now. So at any price you invest, today's ceiling is tomorrow's floor. So don't Never ever try to time the market. It's always a good time to invest.
Also, there is a talk that inflation, government is going to keep printing money. So it's better to be in the market than outside the market waiting for the correction to happen. Because the if government is want to make sure that the market is keep going high uh, for so that they can pay the payments, the debt payments. Is that correct, G? There was some talks about it around.
Yeah. See, like again, we live in a high inflation environment right now. So, but again, this is nothing new. So, 2022, I think we had nearly 6 to 7% inflation, and the market fell 20%. But the next 3 years, the market went up by 20%, 20%, 15%. So, the inflation rate after 2022 fell down to 6.4, and currently we are in somewhere around 3%. So, like, don't worry about the inflation rate. These things are not in our control. So, just have one thing in mind: be plan to be rich, no matter what happens in the market. If inflation happens, try to profit from inflation. Inflation is actually not bad. Inflation is good, right? Let us say, like, you have a house, inflation, you became rich. Congratulations. The real estate value goes up.
Yeah.
You have gold jewels at your home. Congratulations. Your gold jewelry value went up. Again, last year you saw how much the price of gold went up, how much the price of silver went up, all thanks to inflation. So you have assets in your hand, inflation is your friend. And you borrowed money, great. I mean, look at people who borrowed money in 2021. Let us say you mortgaged your house, you got a new house in 2021 at 3% interest rate. You'll be like laughing your way to the bank now. Like next 30 years, you're locked in at a 3% interest rate. So imagine now banks are giving you 3.5% to deposit money. So you got a loan that is lower than the rate of inflation. So don't worry about inflation. S&P 500 has seen periods of high inflation, like the Great Depression. We had a deflation. 1966, 1970s, the oil price quadrupled in one day. During 1973, it called as the Great Oil Shock. 1978, again, we had oil prices doubling in 1 month. So it has seen everything. S&P 500 has seen everything. It has seen high inflation. It has seen deflation. It has seen Great Depression. It has seen world wars. So, like S&P 500 is reliable in all these kind of situations.
Yeah. One more question, G. Likewise, do you suggest CDs and bonds?
Yes, because right now you're getting excellent rates. So, like go 3, 4 years back, you are getting like 0.5%, 1% in CDs. Right now, CDs are giving you 3.5%. So, again, don't put everything in CDs because you are locking in money for 7 months minimum or 1 year minimum. Yeah, they are giving you 3.5%. So, like, let us say you are planning an India trip. So what you can do is, let us say in 2027 summer, you are planning an India trip. You can put like $1,000 every month in a money market fund. And so that you put $1,000 every month from this July to next June, you can easily have $10,000. Withdraw the money, go to India, spend. Don't worry about credit card bills when you return. So in those kind of situations, you can use CDs. And in retirement, you can cover 1 to 3 years of retirement in CDs. People are talking about a strategy called CD ladder. So, like, you can put money up to 3 months in one CD, 6 months in another CD, 9 months in another CD. So that is strategy is called a CD ladder. You can use CDs, you can use money market account, and like if you're talking about somewhat less safer, but AAA rated options, you can use funds like BND. You can use funds like JAA, which are corporate bonds, and there are municipal bond funds. So there are so like treasury bills. So there are so many options. So yes, they do have their place in investment.
Yeah. One more question. I think this is from Harish. I am guessing New Jersey Harish. What's your view about US dollar? We keep hearing that China and other nations are moving away from trading in dollar all the time now.
Yeah, again, like I have been hearing de-dollarization and okay, dollar is finished. 1980s onwards, people are telling like dollar is gone, dollar is finished. Again, I'm not saying they are wrong, but again, you look at the history. Do you think U.S. government is going to let the dollar's value collapse that easily. Like, look at what happened this year. In 2025, January 1, Venezuela was trading in Chinese yuan and with yuan and with Iran in Chinese yuan. So American military goes there, sends a helicopter. Maduro is lifted, airlifted, and then now he is in jail. And now Venezuela is trading in US dollar, right?
We got
So
the
again,
whole
India
US
was
dollar.
trying to trade in with Russia in ruble and in rupees, and Trump threatened tariffs on India, and right now India again I think came back to dollar. So again, like people are saying, dollar value is going to fall. This country is going to move away. That country is going to move away from dollar. I'm not saying that will not happen. But again, like people are saying, look at the other options we have: Bitcoin, gold. Nothing can compete with the US dollar. Any currency that can come anywhere close to the reach of the dollar is euro. And European economy, like I'm sorry to say this, but it is nothing. I mean, it is nowhere close, anywhere close to US economy. Like all European companies, like you can, I'm not just saying it because I like America or anything. You look at the European stock market, you have indexes that track the European stock markets. They don't have any growth companies. They all have old industries like manufacturing industries, like automobiles, like Siemens, truck companies, but they are not the industries that are going to take us into the future. They're all like old industries, and Europe has high taxes. Gasoline is $9 per gallon. So, like, Europe is in no shape or form to replace American dollar. So, people are saying Bitcoin, but the Bitcoin's entire market capitalization is $1 trillion, which I think is less than the GDP of Florida. So, same thing with gold. You don't have enough gold in the world to replace American dollar. So, like, try. Do you think Bitcoin is going to invade Venezuela and capture Maduro? No, it won't. But US dollar will do that. So, like, again, this gets into politics. That's not my goal. But I would say that US politicians and the US government is very vigilant in keeping the dominance of the dollar. And like, I don't see any competition for the dollar. I don't see Chinese yuan. Like, do you think India is going to trade in yuan? No, it won't. I mean, there are like many countries like Sri Lanka. Look at Sri Lanka. Look at Pakistan. So many like many African countries, they traded with China, and they're in very very bad shape due to the trading with China. So again, this somewhat gets into politics, and that's not my goal. But I don't see any competition for US dollars anytime coming up in the near future. 10 years, 20 years, I don't see it. After that, again, who knows what happens.
Two more questions. Um, is moving from townhouse to single family home better, or investing the down payment in index funds, planning to rent the townhouse?
Yeah, this depends upon the prices and the taxes in your area. But in my experience, if you sell your house, whatever house you currently have, you sell your house, just take away 12%. You have to give brokerage commission, you have to pay taxes, you have the moving expenses, and you have to go and buy a house. So maybe like you can save a couple $100,000 by the move, depending upon where you move and everything. And that $200,000, you invest that in S&P 500, like 4% rule, you can get up to $8,000 per year extra. So yeah, I mean, but again, if you're moving from one state to another state, say let us say you're moving from California to Florida, you can save significantly in state income taxes. So only by doing math like that from where you are moving. But again, you move there in Florida. I'm just giving an example. So you move to Florida, they have higher insurance cost, property taxes due to not property taxes. Home insurance premiums are very very high due to the hurricanes in Florida. So there is always a math like that. So like depending upon the area in which you are living, the countries, I mean, depending upon the state, the city, you can easily do the math and see how much you are saving by the move. But generally, we cannot say like moving from a single home to a town home without knowing the prices, the taxes, and everything, how much you are saving. We cannot give a concrete answer to that.
Okay. Last question. When you see the PPP of INR versus US dollar, don't you feel still INR has better PPP?
I don't know because INR has always fallen against the US dollar, not just INR. Any current country that exports significantly to USA always has a motive to keep the currency value low. They don't want to increase their currency value, because if India, imagine if INR increases by 10%, what does it mean? It means the Indian exports are suddenly 10% more expensive than to US. So like US would simply shift, like who would take a 10% price hike, right? So let us say Tirupur garments are being exported to US. INR appreciates by 10%. So it means that the American buyers are now have to pay 10% more. So Kohl's or Target or JC Penney, why would they do that? They'll simply move from India to Vietnam, where the currency value is much, much lower. So actually all currencies reduce their value so that they can be competitive in the American market. So I don't know how INR can even be like compared to US dollars. US dollar.
Yeah, we can move on to the
Okay,
slides.
thank you. So tools to reach fire. So far we talked about the portfolio and everything, how much portfolio, how do you reach the portfolio? So there are different options. One is spend freeze. So spend freeze means whatever you have now, like let us say you have a TV, you have a car, you have a house, don't upgrade. So a lot of people make this mistake. So let us say that you get a new job, your pay goes up by $20,000. First thing people will do is, okay, my pay went up $20,000, so let me go buy a new Tesla. So they'll buy, just giving an example. So they'll buy a Tesla for $60,000. So which means the next 3 years pay hike is already spent. You didn't get a single penny in hand, but the next 3 years payment is gone, $60,000. So think like this. If the $60,000 you bought a Tesla or any car, if it was invested in instead in S&P 500, it can cover like it can grow in 8%, and it can nearly cover like 3 to 5 years of your retirement expenses. So which means that just by buying one car, you have postponed your retirement from age 60 to 65. 5 years, valuable 5 years, 60 to 65. So 65 is not 60. Like you will be significantly older. Your health would have significantly declined. So is the new car worth it? So no. So the spend freeze method says that don't cut your spending, but don't increase your spending. Don't increase your lifestyle. So this is called as lifestyle creep. What is lifestyle creep? Lifestyle creep means like when our income is low, we will buy an Android phone. But when our income goes up, okay, we'll go and buy the latest iPhone. We'll buy the latest iPad. We'll buy the latest car. Then we'll buy the new home. And once we buy a new home, then we'll furnish the basement. We furnish the basement, then we want a home theater, a bar at the basement. And what about a second home, like a vacation home? I want a vacation home in Miami, right? And suddenly you find that, okay, I did everything and where is the money? I don't have any money, right? So don't do that. Spend freeze says that, like, again, these are all very, very powerful strategies. So there is a case in FIRE where two students who were dating each other when they were students, they were staying in a student dorm. So like student apartment. So both of them got job, 6-figure salary after their degree, but they decided, let us not move away from the student lifestyle. Whatever we did as students, let us do the same thing. Let us stay in the same dorm. Let us take the same bus that we took to our college. Let us eat the same food, that same simple food that we ate as students. They lived the same lifestyle for the next 6 years. And after the next 6 years, they both saved their salary entirely and they bought a house. They rented it out. And from the rentals, they used the rental to buy another house. And like within 10-year time period, they had 4 or 5 houses and they easily retired within a time period of 10 years. Just by being frugal for 10 years, they managed to save and retire. So there are many such cases where people froze their spending and then they were able to attain FIRE. Frugalism, like keep your spending low. And again, this is not sacrifice. Again, sacrifice is a very, very bad thing. Like if people feel that I have to sacrifice my current lifestyle to retire, nobody will do that. So please don't deprive yourself of anything. Only thing which we are asking is if you want to pursue fire, don't increase your lifestyle. Be frugal in what you're doing and try to get the same benefit. So, like for example, in 2 days back, there was a very popular Reels video where one lady, she goes to one of the most popular bakeries in New York. So she buys a croissant for $12. So imagine buying a croissant for $12, and then she's eating the croissant, and then she's filming a reel. And the owner of the bakery comes to the bakery with a box of croissants, the same croissant she's eating. She's shocked to see that the box of croissants have been purchased from Costco. So the bakery owner buys croissants from Costco in bulk and sells one croissant at $12 in the bakery. So, when I tell people don't eat at restaurants, I mean, it's the same food you get in Costco. Costco, Walmart, you can get anything. You can get noodles, you can get butter chicken, you can get naan. So, you can get it much, much cheaper than what you can get in a restaurant. So, why are you going there, right? So,
What I mentioned to your this article yesterday happened in an Indian restaurant. They just served frozen paratha. We can literally see it's a frozen paratha and other things actually.
yeah, it's very usual. Samosas. I mean, you get frozen samosas in many restaurants. They just get it, microwave it, or air fry it, and give it to you. So you can do the same thing at your house. So, let us say your hobby in every Friday. Like there are people who on every Friday they say, I don't feel like cooking on a Friday. I need to go to a restaurant. I need to watch a movie. Great. I mean, that's a great thing to do as a family. But now, four people, if you go to a restaurant, it is $150. You eat appetizer, you eat an entree, eat a dessert, including tips, it's $150. Movie ticket is $25. Popcorn is like anywhere from $15. So you come back, $300 gone. So
Yeah.
instead, what you can do is use Netflix, watch Netflix. I mean, you can buy movies, like you can buy $3 movies, $4 movies, an entire family can watch. You can pop your own popcorn. There are many, just put some corn in the pressure cooker with some coconut oil and salt. You can get excellent homemade popcorn, or go to local Walmart. You can get pre-made popcorn, which you can just put in the microwave. You can get the same popcorn, and you can buy meals in Costco. You can buy, for example, all pop like TGI Fridays. So many popular restaurants are selling their pre-made meals in Walmart, in Costco, like noodles. You can get everything, pizza. You can get everything, and so you can get the same benefit. Family night, outside food, popcorn with me, like movies, you can get the same benefit for like $25 each instead of spending $300. So again, that's what I'm saying. Don't deprive yourself of anything, but try to see how I can get the same benefit by using free resources or using cheap resources.
Yeah, we could always go and eat in a park, nearby Park Ramada or something if you want to eat outside of
Yes.
the house.
Excellent. Yes. So just buy a coffee machine, just $10. You get a coffee machine, coffee maker for $10. You make your own coffee. Buy cream with sugar. Brew your own coffee. Just sit in the neighborhood park, meet your friends. You go to Starbucks, it's $7. So you just save the trip. You can get the same. People go to Starbucks not to drink coffee, but they go there to browse, to think. Starbucks itself calls itself as the third home, so that people can come, socialize, talk to each other. So that's the benefit we get on Starbucks. So you get the same benefit in a park with homebrewed coffee. So those are some tools which you can use to reach fire.
Yeah. One more question from Harish, I think. Do you feel retiring at 60 is okay if spouse has a job and can work for further 5 years before her retirement and employment has good insurance coverage?
Obviously, yes. That's called solo fire. So I have a slide for solo fire. So that is one popular strategy that is used by many Gen Z. So I posted a few examples in the fire group. So we had one Gen Z female who worked until 30. So she was a student. She got a job. 6-figure salary. She got married early. She saved her paycheck entirely. So she made nearly $1 million. And then by 30, she had a kid. And then after that, her paycheck itself, I mean, her portfolio itself was generating as much money as she was getting from her work. So she's simply retired, happy at home, and her husband is working. So all the bills are taken care of. And we have other example, Jason Feber. So that's another popular dividend retiree. So that guy retired in his 30. So he retired in 30. His wife is working, but he invested in individual stocks, individual dividend stocks at the time in 2008 when the market fell badly. He invested in dividend stocks. Now he's getting 4, 5, 6% yield in many stocks. He's only spending $2,000. He's getting $2,000 every month as dividends. But he says that is enough to cover his expenses. He's not living at his wife's paycheck, but he says that the house is paid and $2,000 dividend is enough to cover his expenses, and his wife's paycheck and her salary covers the other expenses. Now he's moved to Thailand. So the $2,000, I think he had a divorce or something. He moved to Thailand and his $2,000 dividend paycheck is covering all his expenses in Thailand. So solo fire is certainly an option if our spouse and us, we have a clear understanding who retires at what age. You can decide who retires when. There are many different methods to do it. One is the high earner can work and the low earner can retire early. Or once you have a significant amount in the portfolio, the high earner can retire and then the low earner can retire a couple years later. I mean, in some instances, they work so that they can get the 10-year clock to get the social security payments and everything. So that depends upon the individual situation, but certainly it is possible. And there are like many successful solo fire stories.
Yeah, we can move to slides.
Okay, thank you. So like Gen Z, like boomers, again, don't get confused as who is a boomer and who is a Gen Z. If your birth year has 19, you are a boomer. Just most of us. And if your birth year begins with a 20, you are Gen Z, right? So Gen Z, like again, our boomer generation has many bad habits. One bad habit is that we work till death. So we have a culture where we killed ourselves with work, overwork. Saturday, Sunday, weekend, evenings, we used to check mails at 10 p.m. We used to send mails to each other, office mails, not personal emails. We used to email each other, do work on Saturday, Sunday, sitting on a beach. And then like many people like Chinese, Japanese, Indians, Koreans are all very, very like renowned for working late, working entire lifetime and everything. So Gen Z, thankfully, is not like that. Gen Z is turning fire into a freedom language. There are many Gen Z people, many successful Gen Z fire people who retire as early as 30, who retire as early as 35. Like one example is the couple, forgot the name of them, but they retired in Portugal. They both were government employees. They both retired at 35. They made a portfolio. They bought some Airbnb. They retired successfully in Portugal, and now they are enjoying their fire. So there are like so many successful stories in Gen Z. So like 94% of Gen Z want financial independence by age 55. They're not willing to work like us and make work hustle culture.
Yeah.
So different types of fire. We saw what solo fire is. Next is couple fire. So couple fire is this is just a traditional retirement. A husband, wife, both retire with a significant portfolio, 1 million, 1.4 million portfolio in their 50s. They have 10 years. They have a bridge plan to reach 65, and then they retire after that. So like one example is Paul Adney, or called as the money mustache. He was one of the earliest proponents of FIRE. He was a school teacher in Colorado. So he retired in his 30s with his wife. They have a child. So like he is now retired on an income of $30,000 a year. How does he manage with 30,000? He lives in a small house. He bikes, and he doesn't have many spending expenses. And he runs a blog called Money Mustache. So I encourage everyone to go to the Money Mustache blog and read his journey. But again, he manages very simply with $30,000, a very frugal portfolio. And other option is Coast Fire. So Coast Fire is a very interesting strategy. So like let us say that you are currently 30, you plan to retire at 60. So instead of investing money every year, what you can do is invest up to a certain amount. So let us say from 30 to 40, you invest $500,000. Your portfolio becomes 500,000, and then you stop investing. And then at age 60, your $500,000 portfolio, due to the compounded growth, has become $1 million. And then from the age 50 to 60, don't invest anything. You spend the money, take a world trip, live happily, like whatever your dreams are, buying a house, buying a car, paying for kids' college expenses, do whatever you want. And then like retire with a good portfolio at your age 60. So like again, that's called Coast Fire. Just gave an example. So Coast Fire says that if you are 20 and you have $500,000 currently in your portfolio, you can stop investing at 20, at $50,000 or $500,000. And when you retire at 65, this $500,000 would have become $2.5 million. That would be enough for retirement at that age. So you can see it every year, 20, 21, 22, every year the portfolio value goes up significantly. Like if you retire at 40, you can retire somewhere around $750,000. And at age 70, it becomes $2.5 million. So that is Coast Fire. So you can make the 65 into 55. You can adjust it based upon your age. So that is one strategy, Coast Fire. Foreign fire. So this is one very, very popular method, foreign fire. So like you can retire in social security in many countries. So $2,000 social security for one person. Lot of people are retiring in expat destinations like Philippines, Thailand, Sri Lanka. You find like lot of American expats. Mexico, Panama, Costa Rica, in fact, like has lot of expat enclaves. People are living very happily with $2,000, $3,000 paycheck and retiring in this destination. So
they are living luxuriously.
Yes. Like Mexico, like again, don't think Mexico means all like cartels and violence. There are many places in Mexico, like for example, Merida, which is a very, very popular tourist destination. And there is no crime in Merida because all the cartel bosses' families live in Merida. And the cartel bosses have decided there will be no violence, nothing in Merida.
Wow.
So every cartel has assured the safety of Merida again. And there are other cities in Mexico like Guadalajara. There are many Indian expats in Guadalajara. There are Indian stores, Indian grocery stores, Indian Hindu temples, lot of expat community in the city of Guadalajara, which is considerably safe. And there are cities like other cities in Mexico or in Panama City, Costa Rica. You can live like very, very safely and very frugally with money. So one good thing about this is you don't need to retire. So like for example, like lot of people do something called digital nomad lifestyle. So like they can retire to Costa Rica. Like if instead of two people working, one person can retire, other person can work from home. The time zones are the same. You retire in Costa Rica, you retire in Ecuador. Like there are a lot of people who retire in Ecuador. So you can retire with one paycheck and like you can work from the beach, work from home, and you can get US paycheck. Your social security will be like credits will be adding up, and you will be like getting other benefits from your paycheck. You can come to US whenever you want. Your kids can visit you very easily from, let us say you live in Texas, you live in California. It is just a couple of hours flight away from those places. So foreign fire is one good option. Like again, most of us are from India. So for us, India is a very, very good destination. But one disadvantage is that the time zone is completely inverted. So work from home means you might have to attend the Zoom meetings at midnight. So that would be one disadvantage. So you can consider like a foreign fire option. Like again, if you retire in India, you don't need to work. So as I mentioned, $300,000 can give you easily 100,000 rupees per month. So if you have a home in India, that would be like very, very good paycheck for you in India. And the other fire is barista fire. So barista fire is like, so let us say that we need healthcare. So we have $1 million portfolio, but you need healthcare. You don't have money for healthcare, but you don't have to work your current job, which might tax you fully. You can take a part-time job. You can take a part-time job that lets you work 10 hours. You can switch to a low-paying job that lets you work from home only for healthcare. So you get healthcare benefits, and like you even get a smaller paycheck than that, which can be enough to cover your retirement expenses. You would not have your home mortgage and everything. So that is the barista fire. People call it as barista fire because a lot of fire people work in Starbucks, which has a very good healthcare plan, so that covers their healthcare, and they don't work a lot. They just work enough so that their healthcare needs are covered. So they do in the last 3 years, 4 years of retirement. Instead of calling it a full retirement, you take a barista fire, take a part-time job, so your portfolio is untouched. You are living at a very, very smaller frugal amount with your healthcare being covered. So that was the presentation and the slides that I had. And have any questions? Yes.
Yeah, two more questions.
Yes.
Can you touch briefly about estate tax?
Estate tax is not a problem because I think estate tax kicks in if you have assets of more than $1 million or $1.5 million, right? So, federal level, I don't think any one of us, unless you are very, very rich, you don't need to worry anything about the estate tax. State level, yes, some states would have estate tax, and the only option we have is to move from those states if you want to avoid the estate tax.
Okay. Will we receive SSN benefits if we move back to India?
Yes, you will get SSN benefits because India and America have a treaty, so that SSN benefits will continue to be received if you move to India.
It doesn't matter what status we are in.
No, it doesn't matter. But you should have the 10-year credit.
Okay, I see. Got it. Okay. One more question. So Medicare hits at 65. We can retire at 65, correct?
Yes, you can retire at 65, but that would not be early retirement.
Yeah. 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 Can you tell us about Dynasty Trust, please?
Yeah, like again, if you're there are people who create like revocable or irrevocable trust. You ask about dynasty trust. So that reminds me of Rockefeller. So Rockefeller, when he retired, I mean not when he retired, but when he died, he left his entire estate. I mean, billions and billions of dollars in current value. He appointed J.P. Morgan as the trust. And currently, I think 100 family members of Rockefeller are getting monthly paychecks from that investment every year. So,
Yeah, I think even in Coimbatore, you might have know GD Naidu or their family created this trust. When it comes to PSG, no one can
yes,
sell the
yes.
college or anything. They can reap the benefits of it, but no one can move a single piece of stone from the college.
Yes, yes. So that's again, yeah, if you have significant amount in your portfolio, then when we retire, like when we are 80 or 85, like write a will, write a trust, make your children the beneficiaries, make your grandchildren the beneficiaries, put money in their 520 in an account so they can get money. And like you can ensure that the money stays invested in index funds and they only get 4%, 5% every year. So that certainly can be done.
Yeah, that's a good problem to have.
Yeah.
Any suggestions for fire number calculations recommendation? Like
Yeah, I addressed it in one of the previous slides. So,
I'll share the slides after this in the
yeah,
group.
sure, sure. Yeah.
Can we claim HSA with Indian medical bills when we retire there?
Yeah, I don't know the answer to that question because, yeah, I don't know. Honestly, I don't know.
We can check and probably post it in the groups. Yeah.
Yes, but India, it will be very, very less. So why do we bother? Like, like you can get a triple bypass surgery in India for 500,000 INR, which would be like 10,000 rupees. I mean, $10,000, not even 10,000, 5,000, $6,000. So, I mean, yeah, it's a good amount, but India, the healthcare cost is very, very low. So even if the HSA doesn't cover it, like,
Yeah.
It's not a big deal, not going to be a deal breaker.
Yeah. Next question, I think you already addressed G, but still I'll say, can you talk about fire in India, planning to move to India in couple of years?
Yes, yes. Fire in India is very, very like I won't say easy, but it's comparatively compared to US. If you're planning to move to India, please invest everything in your brokerage account. So, like, create a brokerage account in Schwab or Fidelity. So, if you withdraw money from your brokerage account, like you will pay a tax to you won't pay a tax in US because US government lets foreign citizens invest in the stock market, and the capital long-term capital gains are not taxed by the US government. So you can invest in VOO or you can invest in SCHG or other stocks, other brokerage things, and you can use the Schwab debit card to withdraw money without any ATM fee in India, or you can connect your Indian bank account to your Schwab account or a Fidelity account, and you can withdraw money from there. But again, like if you are moving completely to India and losing your US status, there are ways in which you can continue getting the amount. Like Schwab actually has an international investors account in India for Indian citizens. So talk to Schwab or Fidelity and see your options available. But if you're moving to India, one option is to keep your money in US so that you are continuing to benefit from the strength of the US dollar. Or you can sell everything, take the money. But if you sell everything and move, you'll pay a hefty tax in US. So that's one disadvantage. Then you can go and invest in a Nifty 50 index fund in India, and then you can withdraw money using the 4% rule in India. But try to keep the money in brokerage account in US. You just need to ensure things like having a US phone number and like a US bank account number and an Indian bank account number connected to the US bank, which is very much possible. There are a lot of people who are retiring in Philippines, but all of them are American citizens, so that won't be an issue. But just talk to your brokerage company, Vanguard, Fidelity, or Schwab, and see what options you have.
Okay, great. Um, any suggestions to bring money from India to US?
Yeah, like you can send money from your NRO account. You can send money from your NRO account to US account, and India has different tax slabs for that. So if you send money for education, the tax rate is very, very less, 2 to 3%. If you send money for other purposes, what purpose? Like each purpose, the tax rate goes up 5%, 10%. So if you do through banks, you have this issue. You have to pay the tax, but again, it is possible to bring the money through your NRO account. And there are always other options to bring the money. Like you can, for example, you can like every you go to India, you can bring up to $6,000 without any issues. So, like let us say you go from US to India, if you take above $6,000, you have to declare it. But if you take like $5,999, you don't have to declare it. So, like you go to India, you convert your money into US dollar. Like there are a lot of people who can do that conversion, and like you can bring up to $6,000 without any problems in the Indian customs.
Yeah.
But again, please don't take my word for this
Yeah.
because all these are tax issues. So please double check all this before doing it.
Okay. Yeah, it used to be $10,000, it
Yeah,
seems.
$10,000 is the amount which US customs permit to bring you. $6,000 is the amount which Indian government permits you.
Permits you. Okay. 401k withdrawal, is it tax exempt in India if I retire in India?
No, no. Unfortunately, they even tax the Roth withdrawals. So even though you have already paid a Roth tax in US, Roth tax in US, Indian government also taxes Roth withdrawals. Unfortunately, yeah.
Oh, so this double taxation treaty doesn't apply for this?
Double taxation treaty applies in the manner that US doesn't tax it, but India taxes it.
I see. Got it. Okay. Okay. Yeah. Any other questions? If not, we can wrap up. Okay, I guess no other questions. Obviously, you can always message me. I can ask Selvanji and respond in the groups. And please do join the WhatsApp channel started by Selvan G for this particular topic, fire. I just posted the link again in the chat window. And yeah, thanks for joining. And thanks, Selvanji. I know how busy you are, and you have 70,000 followers, very popular figure in our community. Still, you agreed to do this session for me and for our community. I really appreciate it from my bottom of my heart. Thank you so
Thank
much.
you, Karthik. I really enjoyed my time with talking to this very happy, very like group that looks forward to retirement. So yeah, please follow us the WhatsApp channel.
Yeah,
Only reason I created a channel was that I did not want to create a second group with. The first group is already full. So
yeah,
once we have enough members in the channel, please forward the channel to your friends also. Every day I'll be posting all the fire messages I post in the WhatsApp group in the WhatsApp channel also. So please forward the messages to your friends. And once we have enough members in the channel, we'll create a second group, WhatsApp group, so that you can also ask your questions there. So
yeah.
thank you, everyone. Thank you, Karthik, in particular. I know you are working on this meeting for a long time, and
Yeah.
you scheduled it, and
Yeah,
it's
and you are my first, what do you call, first person to start this whole webinar series. So
oh,
I'll,
excellent, excellent. I
yeah,
hope all your future meetings are a grand success. Thank you.
yeah,
Thank
I'm
you.
sure already people are asking, indirectly asking. I know Selvanji is really good in paleo. Are we going to see a session in paleo? I said, I'll ask Selvanji, and if he's agreed, we will do session on paleo. Particularly, some people were saying that we need paleo for vegetarians and vegans. That's
Yeah.
where a lot of people struggle. So, is there any, session we can do for vegetarian and vegans to reverse their insulin resistance using paleo or metabolic reset for paleo?
Sure, sure. We'll do. Certainly, we'll do a paleo event and focused on vegetarian also in future. Yeah, sure.
Yeah. Thank you so much, Ji.
Thank
Thank
you.
you.
Thank
Thanks,
you,
sir.
everyone. Thank you all.
Yeah, I'll share the recording. I'll put it in YouTube. I'll share the recording after this. Thank you.
Sure. Thank you. Thank you, Karthik. Thank you, everybody. Have a good
Yeah.
Saturday.
Yeah. Whoever is asking for the Arizona Tamil group, please text me. I can share you the link. Thanks.
Bye.
Bye.